Welcome back, everybody. And in today's section, I'm going to introduce to you an also really important topic when it comes to fixed asset and especially bond investing. And it's the question and the theory of bond duration. Basically, it has many methodologies to compute duration, and it also has many terms that must to be clarified right at the beginning. Duration can be divided into two main parts, which you can see here in the chart. The first is Macaulay duration and modified duration. Actually, you can see here the Macaulay duration two times. Later, I will show you why is it here two times, but it's basically just computing the same value with two different approaches. So basically, as I see it, you will get a better overview how to actually compute the Macaulay duration. And afterwards, the output of Macaulay duration will give you the input for the modified duration. And why is it so important? Because the modified duration, which you can see here, is actually gives us the price sensitivity of bond investment. So, for example, it gives you an answer for the question, which is actually really crucial when you are a bond investor. Let's say you're a banker or a portfolio manager. So basically, it gives you a question, which is that once the interest rates rise or fall, then how the present value, so the current price of the bond will react to that. And if you want to get the answer for that, then you will have to compute the modified duration. And if you want to get the modified duration, firstly you have to compute the Macaulay duration. So basically, that's the meaning of today's lecture. We will be trying to get the answer for the given questions. So let's start now and start out with the Macaulay duration computation, but with the first method. Basically, we are computing these values, so the Macaulay and the modified duration for the asset that we have been analyzing in the previous lectures. So, as you can see here, we have 4 years, which is the tenure of the bond. Then we have all these cash flows, which are, as you can see, all linked to the certain values from the previous chart. So as you can see it in the second year, we have an 18 cash flow. Then in the third, we also have an 18. And the last year is a bit different because, as you know, the face value is also paid back. So in this case, we have a face value of 308. So this is the list of cash flows for a given time frame. Now, let's compute again the present value of the certain cash flows. But in this case, I'm not going to compute it again because I've already done it once. So basically, here we are linking certain years' present values. Basically, these were computed here, but it's never a bad idea to actually go over again, especially when it's a kind of difficult computation. So here the result is of the present value is the multiplication of the cash flow for a certain year and the discount factor of the certain year. And here you can see that basically this is the factor with which we discount the year's cash flows. And in this case, you can see that the discount rate is the flat rate of 5%. In this case, we also multiply it with the number of the year, and actually it's all divided by 1. So this is what we have done in the previous sections. So this is how we get the actual discount factors for a certain year, and then we multiply it with the cash flow and we will get the present one. So as I have said it, I've just linked it here again, so you can see it's 1555, then it's about 200, and we add up days, then we will get the same result. So this is basically the present value of the bond, so nothing new so far. And now we have a new column in the computation. This is time multiplied by present value. So in each case, the time of the number of the year is multiplied by the present value for a given year with the bond. Now let's go further. In the second year, we multiplied by the second year by 1633. Then we get a higher result because we have a higher number here. In the first column, it's 3 years multiplied by 1555. And in the last year, we multiplied 4 with 261. In this case, we have a higher present value, obviously, because the total capital is paid back. So now, as you can see it, we have the summarizing cell or the summary cell of this sheet, and you can see it. We have a quite high number. It's 1042. So it's basically a technical chart. And how to get the Macaulay duration from this? Well, basically, we divide the time multiplied by PV with the present value, and if you want to simplify it, we just basically get a value of time. So 3.7 here means 3.7 years. And obviously, the question arises, what does it mean? So what does this Macaulay duration mean? Well, basically, it's the weighted average time the investor would get the bond's cash flows. So compared to 4-year tenure, it's not a bad and not a good value. And it will be the input here in the modified duration. But let's not be that quick, and let me show you the other method. So basically, we will compute now the same 3.7 years, as you can see it here, but with different types of data. It's important because, first and foremost, you will get more expertise in the computation of bonds. And obviously, I just want to be more comprehensive because, in this case, if we look at different approaches, then you will always have the opportunity to foresee better numbers and actually understand the world of investments better. And lastly, and not least, you will be a better banker. So now let's start out. As you can see, we also have here this 4 years of time frame, which is the tenure of the bond. You have the cash flows again, which are linked from here, but basically, these are linked from the actual cash flow sheet or table of the asset. And now let's go back. So here you can see that in the first 3 years we have an 18 and then a 318. So far this chart is totally the same as here. Here the years are obviously the same, but and here we have also no difference so far because we just simply linked the present value formulas from the previous sheet, and we add up them, we will get the present value of the bond. But what differs here is the weight. So what is weight meaning? Well, basically here we just show you the weight of a present value of a bond in a certain year from the total present value. So let me show this again so that you can see it better. So here we can divide the 17 with the 310 and it'll get a 6%. Then we go further. Here the 1633 is divided by 310. Then we get a lower value, so it has a lower weight. And then also we have a 15 divided by 310. Then it's also lower rate, and obviously the fourth or the latest year is basically the highest because the face value or the capital payment happens in that year. And obviously, if we add up these four, we'll get 100%. So if you're rating something and we add up the certain values, then altogether you have to give us 100%. So we have an awesome MACD. I love to call it in that way because I think it's really hard to pronounce Macaulay duration. So let's call it MACD from now on. And it's 307. So basically, it's also the same value. It's also computed in years, but in a different method. And let's see how it looks like. So basically, if you double click into the final result, we see that that it actually looks a bit confusing, but it's not at all. It's very easy. We just multiply the time with the weight of the certain year. So P14 by S14, so it's very easy. It's a subtotal actually, and then 2 times 5%, then 3 times 5% again in the third year, and in the last year, the fourth period, so 4, which is P17 in this case. You can check it here. It's always if I'm telling you good. Yeah, the good result, then it's 4 multiplied by S17, which is 84%, as you can see. So basically, by a subtotal, we will get the same result. It's mathematically the same. So I just wanted to give you a better and higher level overlook on the same problem set. And now we got, as I've said it, the 3.7, which means 3.7 years. That means that the weighted average time the investor get the bonds cash flows is 3.7 years. So we now have one very important piece of information is that it takes 3.7 years to get the cash flows from the bond. If we are the investors, so it's one very important piece of information. And what's more, we have with this information a really important input to the modified duration, which is, I think, the most important part of bond investing when we actually want to evaluate the riskiness of a certain bond. And it's also very good if we would like to compare more bond opportunities, especially in that case when the bonds have similar conditions, like, I don't know, similar maturity or the same maturity, which can be the case oftentimes. The coupons can be also similar, and the expected yields are also similar. So basically, it's very good for evaluating investment opportunities and also compare them. But let's go now further and see how the modified duration looks like. So here I just simply linked the MACD, so which is a Macaulay duration. We have a yield, which is 5% and did not change from the beginning. As you can see, let's go a little bit to the other part, which is the discount rate, which we use for bonds pricing. And here you cannot see, but now I highlighted that we have here the payment frequency annually, which means that our bond in this case once a year. So these are the three inputs that's really important for us to actually compute the modified duration. Here you can see the mod D. So basically this means that it is the modified duration, and how it is computed is very simple actually. So literally everyone can be able to do it and understand it, but let's see now. So basically we use the MACD or the macular duration as an input, which in this case 3.7 years. Then we discount it, or actually divide it by 1 plus the yield, which in this case 5%, and we also divide it by 1, which is the payment frequency in a year. So now you can see that we have a 3.5%, and we have to be able to interpret the meaning of it, which is actually the most important part of this lecture, and that's why I am teaching it to you. And what does it mean? So it means that if the interest rates rise by 1%, the price of the bond decreases by 3.5%. So basically, once the rates rise, then the price of a bond in normal case decrease, because as you might remember from the previous lecture, there is an inverse relationship between the market rates and the bond prices, because basically if you just wanted to tell it to you technically or interpret it in a mathematical way, they are in the denominator of a bond pricing formula, but obviously you have to understand and examine it from a business point of view. So thank you everybody for your attention, and see you in the next lecture.